Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
Okay, let's look at the tape. Closing data, January 28, 2026. MRVL Technology, ticker MRVL. It finishes the session at 83.62. That's up, 0.83% on volume of about 10.25 million shares.
A green close. Wonderful. But let's not uncork the champagne just yet. We need to contextualize that, I think, immediately. That 83.62 is a recovery. A gas for air, really, from a monthly low of 79.80 we saw just last week, on January 20th. But if you zoom out even slightly, the picture gets, significantly grayer. The stock is still down 4.28% year-to-date, and more importantly for the technicians listening, it remains trapped below its 50-day moving average of 85.66. It's struggling.
Struggling for air or just taking a breath before the sprint? See, that is the real question. We're 3 weeks into 2026, looking down the barrel of a forecasted $1 trillion semiconductor gigacycle? The central tension here is obvious, and I think the market is getting it completely wrong. Is MRVL the misunderstood giant that provides the, essential plumbing for this AI infrastructure build-out? Or is it what the skeptics, and I suspect you, are calling a beta trap?
Beta trap is actually the kindest way I can put it. For the listeners who might not watch the volatility indices every day, let's explain what we mean by that. MRVL is trading with a beta between 1.95 and 2.01. That means for every 1% move the S&P 500 makes, MRVL moves 2%. It's twice as volatile as the broader market. But, unlike a high-growth software stock, it lacks the protective moat that its competitors possess. I'm looking at technical breakdowns, heavy insider selling, and a fundamental valuation problem compared to the likes of Broadcom.
I see why you'd flag the volatility. It's a roller coaster, I'll admit that. But I view the setup differently. MRVL has fundamentally pivoted, and I don't think the share price reflects that transformation yet. This isn't the legacy storage company of 5 years ago that sold hard drive controllers. This is now a design team for hire for the hyperscalers, AWS, Azure, eventually others. They're building the custom silicon and the optical DSPs that make these massive AI clusters actually function. I'm arguing that the market is obsessing over the volatility trees and missing the industry forecast forest, specifically that 30.7% growth figure driven by AI demand this year.
I'm sorry, but I just don't buy the market is missing it narrative when the signals are this loud. The market is efficient, and right now, it's screaming caution. We just saw a bearish crossover in January. The 20-day moving average fell below the longer-term averages. That is a classic, textbook warning sign of a trend reversal. And while MRVL was trying to find a floor in the low 80s, look at monolithic power systems. MPWR is the definition of picks and shovels power play. They rallied 24% in the exact same period MRVL struggled. The market isn't blind, my friend. It's selective. And right now, it's selecting against MRVL.
Because I think it exposes a valuation disparity that is actually a massive buying opportunity for anyone with a time horizon longer than a week. You brought up Broadcom. Everyone brings up Broadcom. Broadcom is trading at a market cap of over $1.6 trillion. MRVL is sitting around $71 billion. That is a canyon of a difference.
For a good reason. Broadcom prints money.
Broadcom is a conglomerate. The argument here is that MRVL's pure play status allows it to capture specific high-growth verticals like optical DSPs without the baggage. Broadcom is effectively a software company now that they've digested VMware. They're dealing with integration headaches and software cycles. MRVL is pure hardware infrastructure. That valuation gap suggests MRVL has room for significant expansion as the gigacycle matures. You aren't buying a software roll-up. You're buying the silicon that moves the data.
That distinction is exactly why Broadcom wins. Broadcom has the AI factory ecosystem precisely because of that software layer. They have a moat. They have Google, Meta, and ByteDance locked in. MRVL is trading at roughly 39 times earnings. That is a premium multiple for a company that is supposedly undervalued. Compare that to NVIDIA's leadership position. Does MRVL have NVIDIA's dominance? No. Does it have Broadcom's software ecosystem? No. So you're paying a premium price for a hardware vendor that is exposed to extreme cyclicality. You're paying for a Ferrari and getting a very expensive Honda Civic.
I think you're underestimating the engine in that Civic. I'm not convinced by that line of reasoning because it ignores the strategic value of the IP itself. We have to talk about the SoftBank rumors from late 2025. I mean, that context is critical to understanding the floor price here.
The rumors that went absolutely nowhere?
The talk stalled, yes, but look at the ambition. Masayoshi Son wanted to merge MRVL with ARM Holdings to create a $100 billion entity. That wasn't a casual inquiry over dinner. It validates that MRVL's IP, specifically their 3-nanometer portfolio and custom ASIC work, is seen by the smartest money in the room as the missing link to challenge NVIDIA. Even if the deal didn't happen due to regulatory fears or price, it proves the assets are world-class. You don't try to buy a beta trap to merge with your crown jewel.
I come at it from a completely different angle. To me, the fact that SoftBank couldn't make it work highlights the flaws, not the value. If they couldn't agree on management integration, specifically the reported clash between Rene Haas and Matthew Murphy, or the price, it suggests the takeover premium investors are hoping for is, well, it's artificial, it's a crutch. You can't invest in a company based on a deal that fell apart 3 months ago. You have to invest on the fundamentals, and fundamentally, the memory wall is the biggest hurdle they face.
Exactly. The memory wall is the hurdle, and MRVL is the one clearing it. This is where we need to get technical because this is where the money is. This is the XCon Technologies acquisition.
The $540 million bolt-on? It was barely a blip on the balance sheet.
It was $540 million, but the strategic leverage is massive. We need to explain what this actually does. We're talking about CXL, Compute Express Link, and PCIe switching. Listen, as these AI models scale to trillions of parameters, the bottleneck isn't the GPU speed anymore. It's moving data between the processor and the memory. It doesn't matter if you have a shiny new Blackwell chip, if it's sitting idle waiting for data to arrive. That is the memory wall. XCon gives MRVL the technology for memory pooling. It effectively acts as a traffic cop that allows multiple processors to share memory instantly. It reduces the total cost of ownership for the hyperscalers by huge margins.
Okay, I won't dispute the physics. CXL is necessary. The memory wall is real. But I question the execution risk and, more importantly, the customer concentration. You call them a design team for hire, but right now, who are they hiring out to? It's overwhelmingly Amazon Web Services. Trainium and Inferentia are great wins, sure, but if AWS sneezes, MRVL catches pneumonia. That revenue concentration is a massive risk factor that isn't priced into a 39 PE ratio. What happens if Amazon decides to bring that next generation of switching in-house?
That is a legacy argument. They are already diversifying. Look at the Microsoft Azure collaboration.
Which is a security play, not compute. It's small potatoes compared to the AI silicon.
It is not small potatoes. It's the Liquid Security HSM's hardware security modules expanding right now in Europe. Think of these as the digital bank vaults for the cloud. Every time a government or a bank moves to Azure, they need these modules for compliance. It is incredibly sticky, high-margin revenue. But more importantly, look at the NVIDIA partnership. They aren't just competing, they're integrating NVLink Fusion. We're talking about 1.8 terabytes per second of bandwidth. This ensures MRVL is compatible with the million XPU data center architecture. They're partnering with the market leader, not just fighting them.
That's a compelling argument on paper. But have you considered what the prediction markets are saying about that market leader? I've been watching the polymarket trends as a sentiment gauge for the whole sector. Traders have dropped the probability of NVIDIA being the largest company by year-end from 71% down to 45%. That is a massive sentiment shift in just a few weeks.
That's just sector rotation. It's noise.
It's a signal that the AI-first trade might be cooling, and if the sector rotates, who gets hit hardest? Not the software giants with recurring SaaS revenue, it's the hardware-heavy, debt-laden companies. MRVL has what, $3.94 billion in debt? It is a high beta stock, as we established. If the tide goes out, MRVL is the one standing there without a swimsuit.
I fundamentally disagree with the cooling narrative. The same polymarket data you're citing gives a 79% probability of GPT-6 being released in 2026. Think about what that means. You cannot launch GPT-6 without the plumbing MRVL provides. The infrastructure spend happens before the model release. We are in the sweet spot of that CapEx cycle right now. If GPT-6 is real, MRVL's order book is full.
If we are in the sweet spot, why are the insiders running for the exits?
I knew you'd bring this up.
I have to. It's the most damning evidence on the table. Let's look at the filings. January 20, 2026. The stock is trading at $80.38, near the lows. We see CEO Matthew Murphy, COO Christopher Koopmans, CFO Willem Mijnhuis, the entire C-suite selling stock. Murphy sold over $1.1 million worth. Koopmans $500,000.
And you know as well as I do that executive compensation in tech is equity heavy. These are often tax-related sales on vested equity or standard diversification. It's not a vote of no confidence. It's paying the tax man.
Standard diversification. Come on. It was a coordinated exit at the lows. They sold at $80.38. If they believed in this giga cycle and the bounce back to 120, why sell there? Why not wait a month? It signals they don't see immediate upside. And it's not just them. Fidelity, FMR, LLC, the largest institutional holder, trimmed their stake by 11.5%. When the biggest holder starts lightening the load, you have to pay attention.
But Vanguard increased their position by 27.3%. You can't just cherry-pick the institutional flows to suit your bearish narrative. Institutional ownership remains incredibly high at 83.51%. The smart money, the patient money, is staying put.
Is the smart money really staying put? Let's look at the dark pools, the off-exchange activity. This is where the institutions trade when they don't want to move the price. On January 22nd, the off-exchange short volume ratio was over 50%. More than half the volume in the dark pools is short. That is a massive bet against the stock hidden from the retail tape.
But look at the broader short interest context. The total short interest is only about 4.5% of the flow. That's negligible. And the borrow fee is 25 cents.
That low borrow fee cuts both ways.
It means there is no massive crowded short trade here. The market doesn't fundamentally hate the stock. If the bears were truly convinced this was a zero, the borrow cost would be sky high.
Or it means it is cheap and easy to bet against them. A 25-cent borrow fee means I can short MRVL with almost no carrying cost. And with a days-to-cover ratio of only about 3 days, there is zero fear of a short squeeze. Short sellers are comfortable here. They aren't scared of the bulls. That lack of tension suggests the path of least resistance is lower.
I view the low short interest as a sign that the bears know better than to bet against the structural tailwinds. We haven't even touched on the $5 billion share repurchase program.
Approved in September 2025, yes, but are they using it?
That represents 7.8% of outstanding shares. That is management putting their money where their mouth is. You can talk about insider selling for tax reasons all you want, but the corporate entity, the one that actually sees the order book, is authorized to buy back shares aggressively. That is the true signal of value.
Buybacks are great, but they are financial engineering. They prop up earnings per share, but they don't fix the fundamental issue of customer concentration. The bearish crossover we saw in January reflects a market that is skeptical of the execution.
The execution has been consistent. They've returned over 91% in the last 3 years. The recent dip, this 4% drop YTD, is technical consolidation. It's noise. The signal is the transition from legacy storage to being the optical backbone of the AI data center. Let's talk about the optics for a second, because this is crucial.
Go on.
As these data centers get bigger, the clusters grow from 10,000 GPUs to 100,000 GPUs. At that scale, copper cabling physically cannot carry the signal without massive signal loss and heat. It's just physics. You have to switch to optics. Light? MRVL is the leader in optical DSPs, digital signal processors, that convert those electrons to photons. Broadcom is trying to catch up, but MRVL owns the high end of that transition.
They own a piece of it, but Broadcom is right there with co-packaged optics. And Broadcom has the scale to squeeze margins. MRVL has to win on pure design excellence. And that is a harder game to play when your biggest customer, AWS, is constantly trying to build things in-house to save money.
AWS partners with MRVL because MRVL's IP is superior to what they can build alone in a reasonable time frame. That's the design team for hire model. It's sticky. Once you are in the silicon roadmap for Trainium, you are there for generations.
Until you aren't. We've seen this before in semi-cycles. A key customer pivots and the vendor gets crushed. That's why I harp on the beta trap idea. The risk reward at 83.62 doesn't look attractive to me when I can buy a diversified player or a software-moated player for a similar or better relative valuation.
I think you are too focused on the downside protection and missing the upside explosion. We are standing at the threshold of the first $1 trillion revenue year for semiconductors. History tells us you want exposure to the infrastructure layer during these buildouts.
History also tells us that extrapolations of forecasts are very dangerous, to quote Nick Flaherty. If the AI bubble has even a slow leak, the hardware pure plays suffer first.
All right, let's bring this to a head. We have very different views on what the tape is telling us.
We do. To summarize my position, the technology is real, I grant you that. I'm not saying the chips don't work, but the financial signals are flashing yellow. You have the bearish crossover in the charts, you have aggressive, coordinated insider selling at $80, which is baffling if they see upside, and you have a reliance on a single major hyperscaler, AWS. When you compare that risk profile to a monolithic Power or a Broadcom, MRVL just looks structurally weak. It's a high beta stock in a market that might be rotating.
And I see a company that has successfully transformed itself. MRVL is the essential plumbing for the GPT-6 era. The probability of that release is high, and the CapEx is flowing right now. The XConn acquisition solves a memory bottleneck, the single biggest problem in AI compute right now, and the NVIDIA compatibility positions them perfectly for the million XPU architectures. The current valuation, especially with the buyback support, is a compelling entry point for the long term.
It all comes down to the next headline.
I agree. The true test, and perhaps where we can find common ground, is that MRVL needs to announce a second major hyperscale win.
Exactly. Give me Google or Meta. Break the AWS dependency.
If they announce a custom silicon win with Google or Meta, the beta trap narrative vanishes.
And if they don't, and the insiders keep selling, that $79 low is going to be tested again and likely broken.
That is the gamble. Is the price today a discount on the future of AI or a value trap waiting to spring? We'll let the listeners decide.
It's going to be an interesting quarter.
It certainly will. Thanks for listening.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this and leave your comments below. See ya.